Welcome to Global Plot Economy, where we decode the complex financial narratives shaping our world today with absolute precision and depth. On January 14, 2026, the White House sent shockwaves through global markets by invoking Section 232 regarding silver. This executive action triggered an immediate investigation into whether silver imports currently pose a significant threat to United States national security. To understand this move, we must look back at the Trade Expansion Act of 1962, specifically the powerful Section 232. However, contrary to panic selling or buying, this investigation does not create immediate policy changes or instant tariffs on imported goods. Instead, the investigation is designed to generate a set of strategic options for the President to consider in the near future. The core question is whether reliance on foreign silver compromises the ability of the United States to defend itself effectively. Silver is no longer just a precious metal for jewelry. It is a critical component for modern warfare and energy infrastructure. The Department of Commerce is now tasked with conducting a thorough review, a process that is methodical, detailed, and legally bound. By law, the Secretary of Commerce has up to 270 days to complete this investigation and report findings. This means market participants should not expect a final verdict or immediate executive action until late in the year 2026. They must balance the genuine needs of national security against the potential economic fallout of restricting imports from key trading partners. Once the report is submitted, the President then has another 90 days to decide whether to use his authority to act. Therefore, the full timeline from the initial announcement to actual policy implementation could take nearly a full year to completely unfold. The President has broad powers to adjust imports through tariffs, strict quotas, or by negotiating specific exemptions with allied trading partners. It is crucial to understand that Section 232 is rarely used simply to ban products or manipulate commodity market prices. Instead, history shows it serves as a powerful negotiation tool to force other nations to the table for favorable terms. The primary targets of this leverage are likely major silver exporters to the U.S., specifically Mexico, Canada, and to some extent Peru. The United States imports a vast amount of its silver, making it vulnerable to supply chain disruptions in these specific countries. By threatening tariffs, the U.S. aims to secure guaranteed supply commitments rather than actually cutting off the flow of necessary silver. The goal is to ensure that in times of global scarcity, American industries get first priority over other international buyers. This strategy is about securing the inputs for the defense industrial base, ensuring no shortages occur during potential geopolitical conflicts. To predict the outcome, we must look at the historical precedent set in 2018 regarding steel and aluminum tariffs. When a 25% tariff on steel was announced, prices initially spiked due to market uncertainty and fear of supply shortages. However, the market eventually adjusted as the shock wore off, and the reality of the policy implementation became much clearer. Many nations successfully negotiated exemptions or agreed to quotas, which allowed trade to continue without the full burden of tariffs. The market is resilient and self-correcting. It found alternative solutions and absorbed the costs, leading to price stabilization over time. While the legal mechanism is the same, silver has unique economic characteristics that differ significantly from bulk commodities like steel. The silver market is currently defined by a persistent structural deficit, where annual consumption consistently exceeds the amount of new mining. Global silver production has struggled to keep pace with the explosive growth in industrial demand, creating a tight market environment. A critical factor is that 70% of global silver supply is merely a byproduct of mining other base metals. Silver is mostly found in mines designed to extract copper, lead, and zinc, which makes the silver supply highly inelastic. This means that even if silver prices skyrocket, miners cannot simply flip a switch to instantly produce more silver supply. Their primary operations are dictated by the demand for base metals, not the price action of the silver market itself. This supply rigidity is colliding with booming demand from the green energy sector, particularly for photovoltaic cells and solar panels. Furthermore, silver is irreplaceable in defense electronics, missile guidance systems, and satellite technology due to its superior electrical conductivity. No other metal conducts electricity as efficiently as silver, making it a strategic material that the U.S. cannot afford to lose. The gap between speculative market reaction and the slow reality of policy implementation creates a dangerous trap for unwary investors. Markets often overreact immediately to the news, driving prices up based on the fear of immediate shortages that may not exist. However, the actual bureaucratic process of Section 232 is incredibly slow, complex, and filled with diplomatic back and forth. Smart money understands that this is a long game of negotiation, not an overnight switch that shuts down global trade. Ultimately, the U.S. government seeks stability and security of supply, not market chaos that would hurt its own industries. Investors must separate the noise of the headlines from the fundamental reality of the supply chain and political strategy. The convergence of national security, industrial demand, and geological constraints makes this silver investigation a pivotal moment in history. Thank you for watching Global Plot Economy. Subscribe for more deep dives into the strategies defining our future financial landscape. To fully grasp the implications, we must dig deeper into the geopolitical chess game being played between the superpowers involved. While the investigation targets imports, the silent elephant in the room is the competition with China for critical mineral dominance. China currently dominates the processing capacity for many critical minerals, a vulnerability the United States is desperately trying to address. Section 232 is also a mechanism to encourage domestic processing and reduce reliance on adversaries for refined silver products. We may see incentives for new refineries to be built within North America to close this dangerous strategic processing gap. The USMCA trade agreement will likely be the framework used to resolve these investigations, with Mexico and Canada amicably. Disrupting this trade flow would hurt American manufacturers just as much as it would hurt Mexican mining companies. The automotive industry, a pillar of the U.S. economy, relies heavily on silver for the electronics in every modern vehicle. Any policy that drastically increases the cost of silver would inflate prices for American cars, hurting consumers and voters. Therefore, the administration will tread carefully to avoid inflationary pressures that could backfire politically before the next election cycle. It is a delicate balancing act between asserting national security strength and maintaining economic stability for domestic industries and consumers. Expect intense lobbying from technology companies, solar manufacturers, and automakers to keep silver flowing freely across the borders. These lobbying efforts will likely result in specific exemptions for companies that can prove their supply chains are secure. For traders, the opportunity lies not in the initial spike, but in identifying the dip when the panic eventually subsides. History suggests a buy the rumor, sell the news pattern, followed by a steady appreciation as the structural deficit continues. The fundamental problem remains that we have underinvested in new mine supply for decades, creating a long-term physical shortage. High-grade silver deposits are becoming harder to find, and existing mines are seeing their ore grades decline year after year. It takes more energy and more rock processing to get the same amount of silver today than it did 20 years ago. Rising energy costs and stricter environmental regulations are also driving up the all-in sustaining costs for mining companies globally. Permitting new mines has become incredibly difficult, often taking 10 years or more from discovery to first production of metal. This decade-long lag time ensures that supply cannot react quickly to the demand signals sent by the Section 232 investigation. Meanwhile, the visible stockpiles at major exchanges like the COMEX and LBMA have been draining steadily over the past few years. We are approaching a point where physical availability becomes a real issue for industrial users who need prompt delivery. One potential outcome of the investigation is a recommendation for the U.S. government to rebuild its own strategic silver stockpile. Historically, the U.S. held massive amounts of silver, but sold most of it off decades ago, leaving the cupboard bare. If the government becomes a net buyer again, it would add a massive new source of demand to an already tight market. Such a move could be the catalyst that finally pushes silver prices past their historical highs and into true price discovery. Retail investors often follow the government's lead. If the U.S. says silver is strategic, the public will want to own it too. The American Silver Eagle program has already faced shortages of planchets, proving that mints are struggling to source enough silver. The Section 232 investigation confirms that these shortages are not just temporary glitches, but symptoms of a national security issue. Looking abroad, Mexico and Peru face their own challenges with labor strikes, community blockades, and political instability affecting mining output. The U.S. cannot rely on stable production from these regions if local politics or labor disputes suddenly halt the mining operations. Supply chain fragility is the key driver here. The U.S. needs to know it can get silver even if global logistics break down. Another likely outcome is a push for enhanced silver recycling, from electronic waste turning old phones and laptops into new supply. Urban mining offers a domestic source of silver that is currently being wasted in landfills or exported to other countries. Policy incentives could make it profitable to build advanced recycling facilities within the U.S. to recover this lost strategic metal. While recycling is cleaner, it cannot currently meet the massive volume of demand required by the solar and defense sectors. The transition to renewable energy is non-negotiable for the administration, and that transition is paved with conductive silver. Projections indicate that the solar industry alone could consume 20% or more of the entire global silver supply soon. New technologies like solid-state batteries are also emerging, which could further increase the intensity of silver usage in vehicles. We are facing a potential technology shock where demand accelerates faster than any mining company can possibly plan for. While thrifting and substitution are attempted, the unique physics of silver make it incredibly difficult to replace in high-performance applications. Silver holds the title for the highest electrical and thermal conductivity of all metals, a law of physics that cannot be changed. In space and defense, where failure is not an option, the cost of the material is irrelevant compared to its performance. The military will pay whatever price is necessary to secure the silver needed for their missiles and communication systems. Since silver is a tiny fraction of the total cost of a missile or solar panel, industrial users are price insensitive. They will continue to buy silver even at much higher prices, because without it, their final product simply does not work. This inelastic demand combined with inelastic supply creates the perfect storm for explosive volatility in the futures markets. The bullion banks that hold large short positions could be caught in a squeeze if physical metal becomes difficult to source. A short squeeze in silver is the nightmare scenario for these institutions, and Section 232 increases the risk of this happening. As the 270-day clock ticks down, the uncertainty itself will likely keep a floor under silver prices. Market participants will be hesitant to go short knowing that the U.S. government could announce a major policy shift at any moment. This creates an uncertainty premium in the price, as the risk of supply disruption is priced into every ounce of silver. Behind closed doors, deals are likely already being cut with mining companies to ensure they prioritize American customers first. For the mining industry, this attention is a blessing. It elevates their status from dirty polluters to national security assets. The narrative shifts from environmental concerns to security necessity potentially easing the path for new domestic mine permits. States like Nevada and Idaho could see a renaissance in exploration activity, backed by government grants and streamlined approval processes. We expect to see a surge in funding for geological surveys to map out exactly what resources America still has underground. Investors might find the best opportunities not just in the metal, but in the shares of companies with deposits on U.S. soil. Companies with safe jurisdiction assets will likely trade at a premium compared to those operating in politically unstable regions. Conversely, this U.S. action might provoke other nations to restrict their own exports, leading to a wave of resource nationalism. If the U.S. locks down its silver, China or Europe might respond by locking down other critical minerals, fragmenting the global market. We are witnessing the end of free global trade in commodities and the beginning of a bifurcated strategic supply system. This trend of deglobalization is inflationary, as efficient global supply chains are replaced by secure but expensive local ones. Silver as a hard asset traditionally performs well during periods of inflation and currency debasement. Therefore, the macroeconomic backdrop supports higher silver prices even without the specific catalyst of Section 232. The investigation acts as an accelerant combining with these macro forces to potentially drive the market into a new paradigm. So what should the astute observer take away from this complex web of law, strategy, and economics? First, do not panic about an immediate ban. The process is designed to be slow, deliberate, and negotiable. Second, recognize that the primary goal is leverage to secure favorable long-term supply contracts from allies like Mexico and Canada. Third, accept that silver has officially graduated from a monetary metal to a critical national security asset. Fourth, remember that the mining industry cannot quickly respond to this signal due to the byproduct nature of silver. Fifth, expect significant volatility as speculators react to headlines while the physical market adjusts to the new reality. The long-term current is flowing towards higher demand and tighter supply, regardless of the daily chop in the markets. Silver is the foundational metal for the high-tech green economy that the world is striving to build. Owning the physical metal removes the counterparty risk and places you on the same side as the strategic planners. While the initial news creates a fog of war, the fundamental picture for silver has never been clearer or stronger. Section 232 is the wake-up call that the market needed to realize the scarcity of this essential element. The market is waking up to the fact that you cannot print silver and you cannot fight a war without it. Governments can print currency instantly, but they cannot print the commodities required to back up their strategic ambitions. We may be standing at the precipice of a great repricing of strategic assets relative to financial paper assets. As the investigation proceeds, watch closely for signs of panic buying from industrial users trying to front-run the government. If industrial users start stockpiling out of fear, the available inventory for investors could vanish almost overnight. Watch for backwardation in the futures curve, a technical signal that screams of immediate physical shortage in the real market. Be the wolf, not the sheep. Analyze the policy, understand the lag times, and position yourself before the herd arrives. In this chaotic environment, knowledge of the Section 232 process is your compass to navigate the volatility. The law is the framework, but the market dynamics of supply and demand are the engine that will drive the price. That engine is revving up, fueled by deficits, green energy mandates, and now the heavy hand of government policy. The journey for silver investors has been long and arduous, but the summit is finally coming into view. January 14th, 2026 will likely be remembered as the day the rules of the silver market changed forever. The liquid nature of the market is hardening into a solid structure of strategic necessity and government-backed security. As the winds of geopolitical change blow stronger, only the assets with tangible value and utility will remain grounded. We hope this analysis has provided you with the clarity needed to make informed decisions in these turbulent times. We will continue to monitor the progress of the investigation and update you on any leaks or official announcements. Our radar is locked on Washington, Mexico City, and the global mining sector to bring you the earliest possible warnings. Join our community of critical thinkers by sharing your own thoughts on this investigation in the comments section below. Do you believe the U.S. will actually impose tariffs, or is this purely a negotiation tactic? Let us know. Don't forget to hit the notification bell so you never miss a critical update on the global plot economy. From the Trade Expansion Act of 1962 to the solar fields of tomorrow, the story of silver is evolving. As the world turns, the value of what lies beneath the surface becomes ever more apparent to those who look. The future is bright, conductive, and strategic. Make sure you are positioned correctly to be a part of it. This has been a special report on the Section 232 investigation into silver imports and national security. Our analysis is based on historical data, legal texts, and market fundamentals, aiming to give you the competitive edge. Thank you for your time and attention. We look forward to decoding the next major event with you very soon. Thank you for watching Global Plot Economy. Subscribe for more deep dives into the strategies defining our future financial landscape.